Frustrated with bond returns, especially in retirement? Well, would it make sense to own more stocks? If so, there's 3 problems with that. I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Many retirees are frustrated with what their safe, steady, predictable portion of their portfolio has done over the past, 5 years since the pandemic. That's right. Bonds have been a frustrating investment to hold for investors. And it's not just for investors. Which category of investors? Those right on the eve of retirement and those in retirement, those where you really care even more about how's my portfolio performing. You know that as you get closer to retirement, you should be reducing the amount of portfolio risk or volatility so that you have a greater confidence in the outcome, or you limit the variability in the outcomes. And so normally, traditionally, that's meant reduce your stocks and increase what you hold in bonds. Problem is, bonds don't behave like stocks. And therefore, when bonds decline in value, there's no confidence that, at some point, they'll come back to all-time highs and then they'll surpass those all-time highs. No. Bonds are a very different instrument. And they've come off all-time highs a few years ago, and they haven't recovered. And sure, if we see interest rates start coming down, then bond values will improve a little bit. But it's not like the stock market where, no, just give it enough time. They will eventually recover. So this frustration with bond investments is causing us and many other individuals to say, I feel like I need more stocks. And within our investment planning committee, we're solving for that. And I'll explain how in just a little bit. But normally, if you're just thinking about this and in retirement or on the eve of retirement and say, I need fewer bonds, I need more stocks, well, there's 3 big problems with that you need to wrestle with. And the first is that at odds with your comfort level, or in geek speak, we call it your risk tolerance. And here's what I mean by that in practical terms. If you say, gosh, I can't stomach these lackluster returns from bonds, or they haven't recovered, therefore I need to go more in stocks. Well, if that disrupts your sleep, or if you're spending your retirement focusing on CNBC and watching it all morning, or maybe pulling up or getting notifications on your phone about how the stock market's doing, and that's causing a lot of anxiety and a lot of concern, then you now have invested outside of your risk tolerance, and potentially in your golden years, or at this hopefully freeing time, you're financially free, you're not. You're in bondage because you're worried about the stock market. You're worried too much because you have too much at stake in the stock market. So biggest problem is, am I now taking more risk than I'm comfortable taking? That's one. Tied to that, the second big issue with increasing the amount of stocks that you own in retirement is now you're subjecting yourself more to something called sequence of return risk. And if you're not aware of that phrase or that philosophy, take a look here at 2 different individuals, okay? And they're very clear similarities, but with one very clear difference, and that is you start with the same amount, 100,000. You're taking the same amount of withdrawals, 5%, or excuse me, $5,000 is where you're starting. And then you're going to, also similar, is you're going to have the same average rate of return over 15 years. So same. What's different? Well, the difference is the sequence of annual returns that equate to that average rate of return. And one side, in one scenario, you're going to start your retirement with good returns. And you'll end your retirement, or end of this 15 years, with some negative returns. The average is still the same. But converse that to the alternative, and that is you actually start retirement with some bad returns. And you finish your retirement, or finish 15 years with good returns. The average is the same. Take a look at the ending portfolio value. Nowhere near the same. Very, very different. The amount you withdrew, the same. The amount you started with, the same. Your average rate of return, the same. However, the variation or the difference in timing or the sequence of those returns creates a very, very different outcome. So the more you have in stocks, again, the greater the variation in your returns, and therefore the greater propensity that you've got this sequence of return risk. And then the third reason or issue that is created when you add more stocks because you want to get away from bonds is you now make yourself more susceptible to the barbell investment approach, or the riding the highs and then dealing with some really big lows. And here's what I mean by that. Markets are obviously cyclical. They go up and down, and that happens in big streams, but it also happens on a daily basis. If you look at just how many day or what percentage of each day is positive in the stock market? It's about 50-50. Half of the days are positive, half of them are negative. It's just that the positive days are usually outweigh the negatives, right? So the positives may be up 0.8%, the negatives, down 0.2%. And so that daily percentage of 50% positive, 50% negative, when you stretch it out to a month, it's much greater odds of being positive. Stretch it out to a quarter, much greater odds a year, greater odds 3 years, 5 years, 10 years, and so on. But if you have more in equities and all of a sudden you see a big drop, either because of a bear market or a correction or a really rough day or a yen carry trade, if you're familiar with that, we did a video about that a couple weeks ago, then you might feel like, oh no, I need to get completely out of stocks and go to safety. And then all of a sudden stocks are doing better again and you say, no, I need to go back into stocks and I'm missing out on returns. And there's a propensity when you get outside of your comfort zone, going back to that first issue of being all in or all out, which is an awful way to invest and yields awful long-term returns. So let's then go back to the question. Bonds have been a frustrating investment for the past 5 years, and with what's going on with the money supply and with what's going on with debt and debt instruments, it's very possible bonds don't really improve that much moving forward. And the benefits that we saw of being a bond investor from 1980 to 2020, those days might be gone, okay? And so I wouldn't disagree with you that owning fewer bonds and more stocks makes a lot of sense. In fact, we are developing some mechanisms. That's our approach as well. However, how do you manage the risk, to address the first issue, the drawdown, sequence of return risk, that's the second issue, and then that knee-jerk reaction to, when things are going bad, I need to rush to safety, and then when things are safe again, I need to rush back in. How do you overcome each of those three risks? Well, one, it's hedging. It's hedging. It's actually using some of your portfolio, just a little bit, to buy some insurance. And what that does is, yes, you're having to buy some insurance or buy a hedge, and that is a drag on your return. Yet at the same time, it provides a very predictable path when things do inevitably go negative, go south, or we have those periods of volatility in the stock market. So when you actually mathematically weigh it out, you can own more stocks, but have the same level of risk profile that you had when you owned bonds, or a mixture of stocks and bonds. Therefore, you're overcoming that. Well, can you sleep well at night? Yeah, because you've managed the volatility. Second, because you've got that more predictable performance when things go in the market go negative, you help alleviate a lot of that sequence of return risk. And then finally, because you don't have as much drawdown, there's not as much temptation to say, things are going bad, I need to get fully out. So using strategies intelligently that have hedging, that is the way to help overcome this issue of owning more stocks, but making it risk neutral. Work with your certified financial planner on that. See if that's an approach that you should be taking and that they can help you with. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.